This is Navigating the Middle Market, a podcast by Pitcher Partners that tackles the make or break moments every successful business leader faces when taking your business to the next level. On the show, we'll talk to experts who'll share actionable insights to help you navigate the common pitfalls you'll experience when scaling up. I'm your host, Anna Hacker. In this episode, Yina will break down the critical tax milestones for growing businesses and share insights on tax planning strategies when scaling up. She'll walk through when it's time to move beyond basic tax structures and the impact of rapid growth on your tax obligations. Let's jump in. Hi Yina, welcome to the show.
Thank you for having me.
I am very excited for listeners to get an insight into the more of the tax side now of scaling up. So the first question, how is tax relevant to a growing business?
For a growing business, it's a really difficult challenge to navigate that changing tax landscape. And that's not for, as I said, not for the growing businesses, but for every business. But when you couple that with the way and the rate at which the business itself grows, it's yet just another factor that business leaders and business owners actually have to take into account. And just keeping on top of all of that can, I think, be very, very difficult. So it's these times when, things are changing rapidly. You've got a lot of things on your mind. You've got business things and commercial things and external and stakeholders or things like that where, you can miss opportunities from a tax perspective, but probably more likely is that you'll fall into some traps of not fully complying with all of your tax obligations or not being aware of those tax obligations.
And so it sounds like something where you need to make sure that it is in the back of your mind constantly.
Yes.
And can come to the front of the mind as needed.
Yes.
Presumably business owners, though, don't know what they don't know.
No, that's right. And to be honest, it's not their primary role. Their primary function really is to run their business. Those are the times where people like myself and others around sort of Pitcher Partners is great to, I think, have around to be that support for them, because it is my day-to-day job to be on top of tax development. It's not business owners' day-to-day jobs. They have far better things and far more important things to do for their business.
And so anyone listening, you don't need to know everything. You just need to know the right person to speak to.
Exactly. And that goes for me as well.
So then setting up properly is probably pretty critical. How important is that structuring in the context of tax?
Yeah, so structuring, I would say, is critically important. Firstly, because it's really the first piece of the puzzle in actually trying to figure out how much tax you need to pay or what your tax obligations are. So if I take it as a very, very basic example, is that when you operate a business as a sole trader, you pay tax at individual marginal rates. Whereas if you operate your business as a company, then you pay tax at corporate rates. So it starts from there and then works its way, outwards. But what I'll say about business structuring is that it shouldn't be a set and forget kind of exercise. I think a lot of business owners, particularly when they first start out, get a little bit of paralysis and going, oh, what's the best way of structuring it? And that's not to say that there isn't an optimum way at that time or an appropriate way at that time. But when we sort of first assist business owners with setting up their businesses, we ask a lot of questions. We ask about the vision, right? We ask about where you'd like the business to go, how fast you'd like it to get there, where is it, what are your exit plans, all those kinds of things. And all of that is really to try and distill a structure that is, or at least can cater for a lot of those things and be tax efficient or as much as possible. But at the same time, it's not really realistic or economical to try and plan for every scenario under the sun, right? Like, firstly, it's, the business may develop in a different way or on a different trajectory to what you had first started thinking about. Tax laws change, right? So the taxes that you're planning for or planning to deal with as part of your structure may not actually be there or may not be there in their current form when you eventually do get there. And then lastly, it's because the more scenarios you try to plan for, the more complicated your structure can get. And then the administration costs go up, and that's just really not feasible or desirable, certainly when you first start out. So in my view, structuring is really a series of decisions and also decisions about trade-offs, right? What am I willing to trade off now versus what's really important to me? And then just as businesses evolve, so should structuring.
So I think that most listeners would probably be thinking, I want to set it up properly immediately because I'm worried about the costs, possible tax
Yes.
that might apply if there's a change along the way.
Mhm.
But presumably, and based on what you've just said, there are going to be points where you want to reconsider and think, is this the right structure at
Yes.
this time? And so, what are some of those signs that might lead a business to think about restructuring, particularly from a tax perspective? Because that's why you're here, Yina.
Yes. Um, yeah, restructuring is an interesting concept, and I think people make more of restructuring than what it really is. Restructuring can be large, it can be small, it can be, any scale, and it's often done in response to something that's sort of happening. So where you've got a significant transaction that's on the horizon, it's often a time where most people take sort of stock of things and they step back and they go, is this appropriate going forward? So that's transactions like, if you're looking to acquire a target business or if you're looking to introduce new investors, those are the times when people take that opportunity. But there are also times, I think, where it's appropriate and probably business owners should be encouraged to reconsider their business structures. One of which is oftentimes what I hear is that sometimes, particularly in a trust, if you're operating in a trust, it can be difficult to access financing. So, where you have run into those difficulties of accessing financing, or if there are changes from a commercial perspective or even a personal perspective. So, for example, you might want to improve the asset protection mechanisms within your current structure. That's also a good time to really then consider whether the structure is appropriate, and then also consider whether the structure is appropriate from a tax perspective.
And I think that probably people will be at a barbecue, they'll be talking to mates and thinking, that structure sounds perfect. But I'm assuming this is not a one size fits all.
Structuring is definitely not a one size fits all, and the barbecue conversation is sometimes what we have to deal with from a clients coming to us and saying, oh, but I heard this and I heard that. Why doesn't that apply to me? Tax is very technical. It can be very complex. It applies to different industries, different businesses. And even if you're in the same business, but you're in a different scale or a different size, it can actually apply to you differently as well.
Okay, so then I'm sure that some of the listeners are thinking, okay, things are going well. I've thought about what my structure should be, but are there signs that might lead a business to consider restructuring, particularly, I guess, from a tax perspective?
Yeah, definitely. So, what we tend to find is that when businesses are facing significant transactions on the horizon, whether that be acquisitions of target businesses or the introduction of new investors, that's often a time when it's a trigger point to allow businesses to almost sort of to stop, take stock and go, where are we at? Is it structured appropriately for tax? And so that's usually a good time to do it because people are motivated to do it. Business owners are motivated to do it. But there are other ways and other times where it would be appropriate, I think, to consider structuring from a tax perspective. And that includes when you're expanding into new industries or into new locations, or even, and I'll say this as something that's often overlooked, is that when the costs of administering a group's tax compliance obligations become quite exorbitant. And oftentimes we find that that's when you have multiple entities within a group and there are a lot of intra-group transactions that you've now got to double up on because you've got to account for one side and then the other side as well from both an income tax and a TST perspective. So one thing for a lot of business owners I think they should just bear in mind is that there are provisions in the tax law which try to make that a little bit easier, to try and take some of that red tape, if I call it that, out of that. And that includes things like income tax consolidation, where you're able to treat grouped companies as if it was a single entity or lodge a single tax return. Or alternatively, GST grouping, where you might be able to lodge a single BAS and ignore sort of transactions that are going between entities. And that can make life a lot simpler and certainly your compliance costs a lot cheaper from a business perspective.
And so it might not even be a restructure, it might just be looking at the overall tax obligations and understanding how things can be done a little bit more efficiently and in a more streamlined approach.
Yeah, definitely. And I think it goes back to sort of being open to that and just not necessarily having to be across the nitty gritty of the tax, but just sort of stepping back a little bit and saying, can this be done better? Can this be done more efficiently in various ways?
And so expanding into new industries, you mentioned that as something that might be a trigger potentially for a restructure, but how might it actually change a business's tax requirements?
Yeah, so new industries and new sectors can have different tax rules applied to them. So, just as an example, primary producers have specific rules in the tax law that actually apply to them. So, if you're a business that is very, very used to or has historically operated from a non-primary production perspective and you're moving into the primary production sector, there's a whole series of tax rules that you might not be aware of and have never interacted with that now suddenly apply to you. Now, some of them are pitfalls, but some of them are opportunities. So, for example, primary producers have access to accelerated depreciation for certain assets. And were you not in that industry or never had interacted with that industry, you wouldn't know that. So, it's something to just be mindful of as you're moving into those sectors.
And so expanding into new industries is one thing, but what about expanding into new locations? A change of location or an additional location, does that have an impact at all on tax
Definitely.
obligations?
Definitely. I think speaking from an Australian perspective, going into a different state can have its own challenges as well. Now, we are, I'll say, lucky in inverted commas to have one federal income tax. So at least the income tax won't change much as you sort of expand into a different state. But the state-based taxes are very, very different and they're very nuanced. And the difficulty I find always with state-based taxes is that they're all called the same thing. So Victoria will have payroll tax, as does New South Wales, as does all the other states, but they apply at different thresholds, they apply at different rates. And so all of a sudden, when your business is used to operating in a single state and you've structured your business or structured more appropriately and structured your business processes around a singular regime and a singular rate of tax or a singular rate of a threshold, you may find that that now no longer is appropriate for your business. And now you've got to either overhaul it completely or find something else that deals with your additional obligations. And it's just another source of friction as you move into a different location. Now, that's interstate. Now, when you go overseas, that's now magnified tenfold, hundredfold, right? Because now not only are you dealing with a very different regime, you're also dealing with a completely different country's regime as well. So, for example, a lot of overseas countries don't understand trusts. And so having a trust operator business and then expanding overseas can actually be very, very difficult. And that leads me to that point that I was making earlier, that that change in location or that expansion in location is often that trigger because you go, well, the structure I'm operating in at the moment just can't be done or isn't effective or efficient when it goes to an overseas jurisdiction. But what I'll probably say is that expansion of the business more broadly. So let's not be confined with growing the business interstate or growing the business offshore, but just growing businesses themselves face challenges in terms of additional or different tax requirements. A key one for a lot of businesses is cash flow, right? So just a business that grows, when you grow and you cross certain thresholds, you are potentially required to pay more tax or tax at a different rate. Individuals know this because we have a marginal tax rate system for individuals. But companies also have this. So we have a 25% tax rate for companies which have less than $50 million aggregated turnover and provided that you're not more than 80% passive income. But once you cross that $50 million turnover, while you're under it, you're used to paying your 25% of tax in a company. Once you cross that threshold, you're then paying 30. Now, have you planned for that? Have business owners planned for that, allowed for that in their cash flow? Maybe. Do they understand what the flow-on consequences are? Because we have a franking system. And so there's challenges there as well with how to frank dividends when they come out of that company. The other thing about growth and cash flow is also PAYG installments. You may be very used to paying your PAYG installments quarterly, and all of a sudden you're being required to pay them monthly. And so do you have the cash flow for that? When you grow and you have more employees, withholding, PAYG withholding, any type of withholding can be required to be paid more frequently. So planning for those extra, I guess, pressures on cash flow that comes from changing tax requirements is really critical for a growing business.
And as you said at the start, the business owners need to focus on what they're good at, their business, and they
Yes.
need good advice to support them. So they're not shocked when these things come up that
Yeah,
they might miss.
exactly. Or that they can at least adequately plan for that, right? And that's then, goes back into, it's a vicious cycle or a self-propagating cycle, which is, you need more financing. And when you need more financing, how does that work? Is that easy? Yeah.
And this feels like it harks back to the very first thing you said, which is when you sit down with new clients and talk about what the future looks like.
Yep.
I'm presuming as soon as they mention overseas, you think, aha, this is going to change the structure quite significantly, potentially. Maybe not now, but
Yes.
maybe in the future.
Yeah. And that's part of the conversation that we have with clients early on. So I'll say that it's probably not advisable when you're first starting out to go, I'm going to conquer the world. I'm going to go into all these new countries and I want to allow for tax efficiency in all of them. One, that would be almost impossible to do. And then secondly, is that it's just not cost effective at that time. And that's why I think structuring is something that you do need to go back to often, and as often as you can, anytime that something has changed. I'll also say, just on the restructuring point, is that tax is not always a reason to restructure. Sometimes it is, but there are a lot of good reasons to restructure that is more commercial or potentially more personal as well. So access to finance is one where you might consider restructuring, because a different type of structure might have better access to finance. Similarly, changes in the personal circumstances of the owners, the business owners, and particularly the shareholders or other sort of controllers of the business, if they want, if there's a marriage in the family or if there is a change in sort of circumstances, asset protection can potentially come into play, and you might want to have a look at your structure from that perspective. So tax is not the only reason to restructure, but what I will say is that tax should always be considered as part of any restructure. And that's just because anytime you change something, you want to make sure that it still works from a tax perspective, but also restructuring, the action of restructuring, or the transactions that come within the umbrella of that restructure could potentially have adverse tax consequences. So you want to be ensuring that you look at those and be cognizant of them so that you don't fall into any adverse tax consequences.
And then I think that looking at my pet topic of succession, that's a key part of potentially restructuring, depending on what you want to do. So
Yes.
no doubt that's something that people need to do at the right time. When you're a 20-year-old and you're not married and you don't have children, thinking about what the next generation of your family business or things might look like, it is really hard. So restructuring comes up there too.
Restructuring comes up there, and on that topic of succession, I'll say that, succession is something that the ATO are very much focused on. And so, that goes back to, not only is your business structure appropriate for the growth of that business and the continued success of that business, but it also means potentially keeping the ATO and any other sort of authorities away for as long as possible.
In an earlier episode, James Beaumont emphasised having an acquisition team ready really early was actually quite critical. And that's probably the same for all types of business endeavours, because the planning as early as possible makes things easier to manage going on. So from a tax perspective, is an acquisition, whether it's a sale or an acquisition, what should businesses map out with their tax advisor before they start looking at those sorts of targets?
In this respect, it's probably a little bit of horses for courses. What I will say is that, taking James's point about having teams that are ready from a tax perspective, means having a tax advisor who understands what you're looking for and what you're looking to acquire. So, sale transactions and acquisition transactions invariably take one of two forms. They're a acquisition of assets, or they're an acquisition of ownership interests, which can be either shares or units in a unit trust. So the form itself is probably not particularly controversial. It's really more how to then integrate that new business or the target business into your existing business. And that requires a very robust understanding from your tax advisors of what your current business is, how it's structured, and then so that they can then look at the target and assist you to work out what is the best way of integrating and how is that, and what is the most tax efficient way of integrating. So the readiness from a tax advisor perspective is not so much forward focused as it really is just having a tax advisor that is aware of what's around your group, what the options are, and how the group might sort of then change and how the group operates, so that any change doesn't disrupt what it currently does.
This has been such an illuminating conversation, Yina, but is there anything else you'd like to leave the listeners with?
From a tax perspective and in the context of a growing business, I think it's more for business owners to really just be aware that it is not a one size fits all. There are different things that can be done depending on what your needs are. It's being aware of what those needs are and then being open to the prospect of changing certain things. Now, that's not often advised to do it frequently, but just knowing when to sort of ask that question of your tax advisors. Is this appropriate? Is now a good time to have a review of my structure? Having something like that and doing it semi-regularly, I would say, would, I think, go a long way to making sure that business owners are prepared for the changes coming down the road.
Great advice for our listeners. Thank you so much. You've been listening to Navigating the Middle Market, and we're coming to the end of Season 1. We hope you're walking away with insights you can put to work right away. This podcast is brought to you by Pitcher Partners Melbourne. Head to pitcher.com.au to find out how we can help you scale. Season 2 is coming. Subscribe or follow in your podcast app so you're the first to know when it drops. And a 5-star review helps other business leaders find the show. I'm Anna Hacker. Thanks for being part of Season 1, and I'll see you in Season 2.